Did you know that preparing your home service business for private equity investment, if done the right way, could increase the value of your sale by hundreds of thousands or even millions of dollars? I'm going to break down the exact correct way to do it into 3 easy steps. My team has done over $200 million in closed transactions, and I've worked with dozens of business owners personally to maximize the value of their sale using the right packaging and the right presentation of their business. Stick around because later in the video, I'm revealing the biggest mistake that business owners make when they go to prepare their business this way and how you can avoid it when you go to sell your business. Most business owners have no idea that private equity looks for very specific financial structures, operational efficiencies, and growth strategies when they go to buy a business, and they're willing to pay top dollar for just the right business. And you can simply package things the right way. You might already have a great business that you could just package the right way, and if done correctly, add much, much more to your sale. Now, on the other hand, if your business is not set up correctly, if you don't know how to package and present it, you could lose hundreds of thousands or even millions of dollars of value in your sale, or the investors might just walk away entirely and not have any interest in your business. If you don't know how to present it, they might just not be able to underwrite the deal. Most business owners leave millions of dollars on the table when they go to sell their business because they simply don't know how to package it correctly and present the growth opportunity for the right buyer in the right circumstances. Private equity firms reject businesses that are not structured properly or not packaged properly and don't have a good growth plan. With the right preparation though, you can increase your valuation and close deals way faster. So there's 3 very critical things that you got to get right in your business if you want to package it and sell it for the most money possible. So let's break them down. These are financial readiness, frame and structure, due diligence and deal structuring. And there's one bonus tip I'm going to give at the end of this video that no one thinks of, but if you do, you will literally have private equity firms frothing at the mouth for a chance to bid on the top dollar for your business. It's actually pretty crazy, and I've seen it happen. So the first thing that you have to do is you have to prepare 3+ years of your financials. And this is profit and loss statements, tax returns, balance sheets, cash flow statements. These are all the types of things that are going to help you tell the overall story of your business. Now, a little tip here, that just based on everything that I've seen, all the deals that I've worked on, we're gonna wanna see at least 2 years of monthly profit and loss statements. And this is something that most business owners do not have. And ultimately this holds up deals. This makes it very difficult for us to understand from an investment standpoint, is this business very seasonal? How does it look? It's not a problem if it is seasonal. Many home service businesses are seasonal, but we've got to be able to see that seasonality and know what to expect and know, how our investment is going to be returned. Now, another tip is if you segment out your revenue by service type, so that's commercial versus residential versus industrial. It's also if you're doing multiple types of service. Let's say that you're an HVAC company and you're doing some installs, some repair, some maintenance. You want to break those out by service type so that you can tell the full story there. And most business owners that I've observed just are not doing this. Usually you want to include this in your profit and loss statements. If you start doing this early, this will be great for you anyway from a growth perspective because you'll be able to understand exactly which services give you the highest profit margin, and you can just double down on those again and again, which is what we're going to do if we acquire it as private equity. We're going to look for those services that bring the best cash flow possible and just look to figure out how we can double down on those because that's what makes the most sense. Now, the next thing is you want to convert all of your books to accrual accounting. Many business owners, I've noticed, just go by cash-based accounting. And when we look at this as private equity, we want to understand when revenue is earned, not when it's received. This is important because there's things that we could do to ultimately speed up the cash collection process. There's all kinds of things that we can work on, but we ultimately want to understand when the actual revenue is being earned, not received, and simply will not trust cash-based books. So you need to convert your books from cash-based accounting to accrual accounting. Many people I've noticed don't even realize which one they are versus the other, but it's very simple to understand. It's simply, you want to record your revenue in your books when it's earned and not when it's received. So a little bit of a tip here is if you use QuickBooks, if you're not using QuickBooks, you probably should go ahead and start using QuickBooks. But if you are using QuickBooks already, you can simply go in on QuickBooks and switch from cash-based accounting to accrual and how you actually show your profit and loss statements. And this could be very helpful. Now, another thing that you're going to want to do is you're going to want to optimize your EBITDA. If you're not familiar with what EBITDA is, this is simply another kind of a fancy word for your net profit of your business. So many times the issue is that you're showing as low of a net profit as possible for tax purposes. And this is fine. This is kind of something that most business owners do. It's not like it's illegal or anything, as long as you're being smart about it and you're not overdoing it. But the reality is that your business is probably going to show as less profitable than it actually is, less profitable than the actual amount of money that you're taking out as a business owner, because there are some expenses that you're having that the future owner is not going to also have. So if you add those back to your net profit, this gives you something called your seller's discretionary earnings. And this is something you definitely want to show and be able to present, because if not, you're simply missing out on value. You could be missing out, in some cases I've seen, missing out on over $1 million, sometimes over multi-million dollars, simply because things are not being added in the correct way. So an example of this is if you pay for your personal vehicle as a company expense, this is a legitimate company expense that you can write off. But the reality is that a future owner is probably not going to need to have a personal company vehicle that's being written off. And so you can actually add that back into the profit. Let's say just as a crazy example, that vehicle is $50,000 a year in payments. That $50,000 would simply be added to your net profit and increase the actual profit that we're looking at when we go to value your business. This is going to ultimately raise the valuation of your business overall. Which brings me to another tip, which is to get a third-party valuation. This is so key. This is one thing that so many business owners miss out on and end up really losing control of their sale, which results in either not having the sale go through or a much lower sale than they thought was possible or that they were going to get. Because when we look at it as private equity, you have to remember our goal is to pay the lowest amount of money possible that we can justify to get this business. That doesn't mean that we don't have a budget to pay a higher price, but we simply are incentivized to pay the least money possible. It's simple math. If we spend less on the business, we get more of a return. So of course, we're going to go ahead and give our own picture of the valuation. Of course, we're going to say what we think the business is worth. And there are many, many things that you can do as an investor to try to lower the value of the business and give reasonable reasons to lower the value of the business. And you, as the person selling the business, you simply do not want the narrative to be dictated by the person buying your business, because they're going to try to pay less for your business. They're not in it to pay as much as possible for your business. It just doesn't make sense. So if you go get a third-party valuation, you get to own your own narrative. You get to actually get the most valuation possible for your business that is justifiable and legitimate, because that third party is going to be doing it for you and showing an objective look at how much your business is worth. That doesn't mean that's what your business is going to sell for, but it can establish kind of a baseline of the bottom line of what someone should be willing to pay, and make sure that you don't get less than that, and also that you understand that you need to get at least that much for it. Now, a tip here is that you can use a company with actual M&A experience to have much better results here. A lot of people just go to whoever's already doing their bookkeeping, their taxes, and the reality is that these people probably have not been through mergers and acquisitions before. Even though they might be great accountants, save you on taxes, this is a whole different language. You have to think of it that way. So you want to go to someone that has actual mergers and acquisitions experience, knows what add backs mean, knows which things are legitimate add backs, which are not, and knows how to actually classify it, knows how to show comparable business sales, knows how to bring all these things together to show the true valuation of your business based on multiple things. And so the sponsor of today's video is Out of the Box Consulting. This is an actual M&A outlet, an actual M&A company that does these professional valuations. They are CCIM Business Valuation certified. They do really great work. I've worked with them plenty of times before. And so they are today's sponsor of the video. If you do need to get a valuation of your business, they do really good ones, factoring in all these things that we've talked about. Now, a tip here is that if you have the valuation include industry trends and comparable sales, you can actually potentially raise the value of your business, because this is literally you showing, hey, here's a business in my industry that sold for this much, so my business should as well, or should sell for more, or my business is worth a little bit more because of these factors. I've got more employees or more profit, something like that. Now, another thing is operational excellence in your business. You need to document your systems in a really great set of detail. So things like sales, marketing, HR processes, customer success, financials, how you handle financials, your operations. All these things need to be documented well so that when someone's looking at buying your business, they can see that there's actual scalable, repeatable processes within it. This is ultimately going to raise the value because it means that there's less manual work that it's going to take for the new owner to actually run this business, and that they're buying a legitimate built system versus just something that works for you as a job, if that makes sense. Now, a tip here is that you can use technology to make this way easier. You can use things like Loom, which actually record video. It records the whole video of your computer while you're using it, so you can do tasks, type away and go away at your tasks on your computer and just record exactly how you're doing it while you talk, and have like a nice easy video to share with someone. Neither of these are sponsors of today's video, but just things that I use a lot that are really great. Notion is a great one as well, just a very good organized kind of note-taking application. And Trainual is great as well. It just simply kind of creates standard operating procedures as you do things on your computer, record your processes and have them really well documented, so that when you have a new hire or when someone does go to take over the company, they know exactly what has to be done for all these processes. Having this in place just kind of creates lower risk in the mind of the person buying your business, because they know that even if like a key employee left or a few employees left after the acquisition goes through, they know that they'll be able to just plug people in and they know what to do already because they have it all documented down. Any way that you can lower the risk of your revenue is going to increase the value of your business. If you think about like major software companies that sell, for example, they literally have monthly subscriptions a lot of time for the software. So they sell for really, really high multiples of their profit or even their revenue sometimes, because the revenue is very low risk. There's a very, very high likelihood that revenue is going to keep coming in. So we're going to talk about a couple ways that you as a home service business can actually lower that. So for any customers that you have, especially if you're doing stuff over and over again for them, let's say you're a landscaper and you're cutting their grass every month or every couple weeks or something, whenever you can have some kind of signed agreement or contract, this increases the likelihood that revenue will keep coming in. So that revenue is actually worth a lot more and much less risky. So as you're kind of preparing for this, having that in place is really good. Also, having no one customer represent more than 15% of your revenue. If you have big customers that are more than 15% of your revenue right now, you should try to get more customers and just spread that out more. Because if you think about it, if you were buying a business and all of a sudden, one customer got lost that was kind of like a customer that requires more attention, pays a lot compared to some of the other customers. If you acquired that business and then that customer was gone the next day, that's a huge problem and it makes the business make way less money. So it just decreases the risk if you have a lot of customers versus just a couple that are bringing in all the revenue, even if they're great customers. Another thing that's really key is for any key employees, people on the management team, people that are handling operations, if you can lock them in and make sure that they're going to be staying in the business as likely as possible after the acquisition goes through with contracts, incentives, bonus structures, performance-based pay, anything that you can do to make it more likely that they'll stay after the business gets purchased, it's really, really going to help you increase the value of your business in the perceived mind of the private equity purchaser you're preparing it for. So another thing just broadly that you can do is start kind of stepping away from some of the things that you're doing in your business right now. Whatever daily tasks you're doing, just try to start delegating them to some of the people in your business. Even if this means you have to start paying them a little bit more, I promise you this is going to raise the value of your business, because you have to think of it as you're selling something that will not have you in it. Even if you do stay in your business after you sell it and still help out, you're going to get way bigger of a sales purchase price if you've designed it so that it can run without you. And so delegating these tasks is really key. One thing I see a lot of people do as they prepare for their business, and that I always encourage, is actually just start scheduling random things like in the middle of your workday. Like schedule a massage in the middle of the day that you're gonna have to go leave work for and come back. If you're especially if you're kind of a workaholic, this can really help you kind of stay out of those daily tasks and make sure that other people have to take them on. And the most important thing here is if you can name an actual CEO of your company, you are going to raise the value drastically. Here's a little dirty secret of private equity that you're probably not going to see coming, which is that when we go to purchase a business, and let's say that it's doing $1.5 million a year in profit, but the owner is basically acting as the CEO, we are probably going to have to go hire a CEO that has, especially one that has mergers and acquisitions experience, to be the CEO of the business after the current owner leaves or takes a step back. So that's going to probably cost us $200,000, $300,000 if we want to find someone really, really good that will help grow the business. So all of a sudden, that same business that was doing $1.5 million a year in profit, that becomes more like 1.2 or 1.3 million, and that's going to drastically lower the valuation, maybe by as much as $1 million, because when you talk about the multiple of the profit, because there was not a CEO in place before. So the best thing you can do, if you could hire a CEO in your business that has been through some kind of merger or acquisition before, or maybe a couple of them, that's the ultimate step, but at least name a CEO that understands the operations of your business really well here. And then the next thing that you got to do is you've got to kind of frame and set up the deal. So everything I'm about to talk about here has to do with framing that deal, setting it up, packaging your business as a great opportunity. So the first best thing that you need to do here is set up a data room, basically just an online storage facility where you can have all of the files stored, some of the stuff that we've talked about before with the standard operating procedures, the financials and stuff like that, all needs to be in one easy to access place where you can share it with the right people that need to get information in order to see if your business is worth buying. So a tip here is you can use things like Dropbox or Google Drive if you want to do it for free. These have plenty of storage on the free versions to store really everything you need for your business. But if you want something a little bit more secure, again, not a sponsor of today's video, but one that I use pretty regularly is Box. This is a paid solution, but it's a little bit more secure and just mergers and acquisitions friendly. Just the way it's set up, you can go in and take notes on files and documents, just a little bit more set up for mergers and acquisitions. Now, things that you need to have, again, in here in this data room are your financials, your legal paperwork, contracts, vendor contracts, employee contracts, stuff like that, information about your business entity, kind of showing that stuff, tax returns, a CIM or a confidential information memorandum, really big key there. If you don't have one of those already, it's a fancy marketing brochure just to show your business as an opportunity, very key thing to have in there. Information about your company background, just anything relevant that you could think could help enhance this opportunity in the mind of someone buying it is what should be in your data room. And a bonus tip here is what we love to do in any transaction is we love to create a kind of a master question and answer sheet so that you don't have to answer the same questions over and over again. So for example, if I was asking you, hey, what's the split between residential work and commercial work in your business? And you said, hey, it's 60% residential, 40% commercial, you could go ahead and put the answer to that on your master question and answer sheet. So if you're talking to a lot of different firms, a lot of different potential buyers, you could just share access to that sheet so that instead of having to go back and forth and ask all these questions to you all the time, wasting your time, wasting their time, slowing down the transaction, you've got all these things already answered and ready to access. And another thing to do here is you've got to understand like the key deal terms that are going to be a part of this transaction. So these are things like an earnout, seller financing, all these other things. So I'll explain a couple of those real quick. So an earnout, I'll explain seller financing first. So seller financing basically means if your business sells for $10 million and you seller finance half of that, that means 5 million of the 10 million is going to be paid immediately, and the other 5 million is going to be financed in payments over time. So you've got to understand what your kind of personal financial situation is going into this so that you know how that works. Now, an earnout is the same thing, except that second 5 million that's paid out over time has certain milestones attached to it. So it might not happen if you don't meet certain sales metrics in the business. Now, this is usually done in order to just make sure that the person selling the business has a little bit of skin in the game of the business to make sure that the process goes through. And these are usually looked at as kind of a negative thing. And I would encourage you not to necessarily see them as purely a negative thing. What I always say is there's kind of a law of price and terms here, which means you could sell the business for your price, but it's probably going to have to be on your buyer's terms, or you could sell it for their price and it's going to be on your terms. So it might actually behoove you sometimes to be flexible on these things, because that same maybe $10 million business, maybe you want $14 million for it, for example, but the buyer doesn't have enough money to just put that all down in cash. And also, if they did, you'd be paying most of that away in taxes anyway. So it actually might make more sense for you to stay in for a couple of years, maybe even keep part of the equity permanently if you like the growth strategy. But it might just make sense for you to stay in a couple of years and kind of help out and make sure that everything goes smoothly and actually make that 14 million instead of 10 million for your business, but you earn it over time, over the course of a little bit of time. You probably don't need all that cash at once anyway. You probably don't want to pay the maximum amount of taxes, so it would be better to receive it over the course of a few years potentially, just depending on your personal goals. And that brings us to a hugely important point that is deeply personal, which is you've got to know your future plan. You've got to understand whether you're open to these terms and whether you want to hold on to some of the equity, or in other terms, roll equity is what that means, or not to roll equity. And this is where you want to understand what firm is buying you, what their track record is. Are they likely to have a really huge growth of this business? Very important thing for you to understand. Are you willing to keep equity in the company after you sell it, or do you want to be out of it entirely? And I will tell you right now, it adds to your negotiating position and your leverage if you're willing to stay in, because again, this is just security in the mind of private equity. This shows that you have an actual interest in the business still, and that you think it's going to continue to be successful if you're willing to keep some of this equity. It also means that after the purchase, there's just going to be some potential advisory from you just to at least help out. And this just increases the likelihood of success of the business at the end of the day, and shows that it's something you feel confident about. So this could be a great strategy just to, keep going with that. Also, just as a way of maximizing your sale, a lot of people don't realize this, but you can actually sell your business twice or even multiple times. So you could sell, for example, 80% of the business for $8 million. And then later down the road, after some growth and after kind of a roll-up strategy of sorts, which is a topic for another video, and I've got some good videos about it. Maybe I'll link one here. But after some growth with this private equity firm, you might be able to sell that remaining 20% equity that you have, sometimes for even more than you sold, than that 8 million that you sold the 80% for, if we're using that $10 million example. So a very interesting way to maximize your actual value of your business sale. So at the end of the day, a huge thing as all types of sales, you know this as a business owner already, but the more urgency and scarcity you can create in the deal, the better. So here is where, if you're talking to multiple firms, multiple potential buyers, you want to make it known to each one that you have other offers on the table, that you're talking to other people, that there's other people reaching out to you. And if this is not true already, then you should go make it true. Talk to multiple buyers so that you can up the urgency and the scarcity of the deal. They'll be wanting to act quicker, do the deal quicker, and potentially pay more for the business to make sure that they secure the offer, which is great for you. And be prepared to speak to those multiple firms. All the stuff leading up to this, all the data rooms that we put together, the financials, everything that you organized, all this work that you did to prepare your business is so that you can go speak to these multiple firms in an organized, efficient way, actually get it done, and be able to do it at a large volume while running an actual business that still probably needs some input from you. So next, you're going to prepare a growth plan with actionable projections. This is the thing that no one really does, but I'm going to describe a way that you can do this. Again, that's going to have these private equity firms literally frothing at the mouth to pay a bunch of money for your business. This is if you did everything else correctly. So what you're going to do is you're going to actually develop a mergers and acquisitions pipeline for the post-acquisition phase. So the most likely strategy that a private equity firm is going to be doing in this current environment with your business is they're going to be looking to either start with your business or add your business on to what's called a roll-up. And in simple terms, all this means is they buy a bunch of businesses together so that they can sell the whole package for a lot more money. It's like how the individual pieces of a hamburger are not actually worth a whole, $4, $5, $6, $7, $10. A piece of lettuce might be worth a few cents. A piece of beef might be worth, at the most $1. Piece of tomato, a couple cents. Piece of cheese, a few cents. A bun, a few cents. But all of these parts together as a hamburger are going to be worth a lot more money than the individual parts together. It's the same thing with businesses. So what you're going to do to raise the value of what they'll be willing to pay for your business is actually go and scout out businesses that it would make sense to acquire to add on to your business. Now, in just meeting these people, these other business owners, and negotiating with them, maybe you know some of them already, so you should start in your personal network. But having this growth plan already lined up and these relationships, maybe even pre-negotiated as part of this roll-up plan, adds so much negotiating power to your sale. It's actually insane because all private equity wants to do is step into an already existing plan and just cut the check, make it happen very quickly. This speeds up the amount of money this increases the amount of money that they can give you. It speeds up the process of them being able to go through with the plan. And ultimately, if you do the work of setting this all up, it allows you to increase your price as part of their overall budget for this plan, if that makes sense. And this is the thing literally no one does because they just don't know what the plan is and they don't really understand what the value of their business is. But this is one of the biggest things to increase the perceived value of your business and the growth plan that comes with it. So a big thing that you can do is just kind of pre-negotiate those deals a little bit. Maybe your business is worth like a 5 times multiple and you go out and find a couple 3x and 4x multiple businesses that are going to be part of that growth plan. Private equity is going to love this, and ultimately you can ask for a lot more for your business because of this. So what do you actually do next here? Now that you've got all of this stuff prepared, if you're actually at the stage where you've done all of this stuff, or maybe you want to do this stuff, but you don't really know how to do it the right way. Maybe you don't know how to personalize this to your business, or maybe you're just worried this is too much work for you to handle as you're running this business, or you want someone to step in and do it the right way. Again, my team has done over $200 million in closed transactions, including a roll-up of an HVAC company where we actually went out and bought 5 HVAC companies together, organized them together, and this sold for a 6.7 times return on the invested capital. That means if you kept 20% equity in your business until the sale, it actually was then worth 6.7 times that. So if you think a strategy like this might benefit your business, or if you at least want to hear a little bit more about how it would work for your business personally and what you can do personally to increase the value of your business leading up to the sale, you can book a call with my team in the link in the description. We would love to talk to you about this. This is our bread and butter of the exact kinds of deals that we look to do. And if you want to learn more, click the video above. See you on the next one.